Right, so let's look at dividends. Shape Up Limited, registered with an authorized share capital of 1 million shares. A prospectus was issued, and on 1 January, 800,000 shares were issued to the public at an issue price of 5 Rand each. Okay, so there's 800,000 shares in issue to shareholders. On 30 June, that's halfway through the year, an interim dividends of 90 cents per share was declared and paid to the 300 shareholders listed in the company's share register. On 31 December, that's the end of the year, the profit and loss was determined and a final dividend of 40 cents per share was declared by the directors to the 300 shareholders in the company's register. Right, we know the year end is 31 December. Show the effect of the above two transactions on the journals, the ledger, and the balance sheet. Okay, just before we start on this, there's two transactions here. The interim dividends paid and the final dividends that was declared. So the paid portion and the declared portion. Dividends is one of the reasons that shareholders will invest in shares of a company. The other reason, which is probably the more prevalent reason, is the capital growth that shareholders is expecting on their shares. Nevertheless, let's look at this transaction and how this will be accounted in our records. So firstly, how are we going to calculate the interim dividends paid? Let's look at our calculation for that. We're simply going to take the number of shares and we're going to multiply by the dividends per share. So our interim dividends was 90 cents per share. There's 800,000 shares in issue. So we're going to say 800,000 times the 90 cents, right? That's 0.9 rands. And that's going to give me 720,000 rand. All right, let me make that one rands. So there we go, that's rands. And the final dividends was 40 cents per share. Again, the exact same principle. Take the number of shares, which is 800,000 rand, and we're going to multiply that by the 40 cents per share. Look at the top here in the formula bar, and that's going to give me my 320,000 rand dividends at the end of the year. Now this one would have been paid and this one would not yet have been paid. It's only been declared by the directors and this one has already been paid. So let's look at the two accounts affected for transaction number one. Well, as always, we ask our three questions. Number one, which accounts are affected? The first account affected here is dividends on ordinary shares. All right. And we also have our bank account, since we have paid the interim dividends of 720,000 rand. Second question, we now need to decide what type of accounts are these. We already know bank is an asset, and we know that our asset decreased here because we gave out money. Let's have a look at dividends on ordinary shares. So what type of account is this? It's definitely not something the business owns, so it's not an asset. The business doesn't owe any money to anyone here because they've already paid the dividends. It's not something that the business has actually used up or consumed really, so it's not really an expense. It's not really money going out or the promise of money going out. It's not really an income because there's no money coming in and there's no promise of money coming in. It's not a liability because we don't owe any money to anyone. And it's not really equity in the sense that it's not really increasing the net worth of the business. However, it is decreasing the net worth of the business because we are distributing some of the entity's profits. So some of the entity's profits is being distributed to my ordinary shareholders. So this, in fact, is, for our purposes, we're going to refer to it as a negative equity. Because as my dividends increases, my equity is going to decrease. You can think of it in much the same way as drawings that we had for a sole proprietor. So in terms of my dead click rule, it's going to be the same as the drawings. Right, so what happened to my dividends here? Did it increase or decrease? Yes, it increased. We paid out more dividends. So let's apply our dead click. Here we go. Debit expenses, assets, and drawings if there was an increase. Credit liabilities, incomes, and capital if there was an increase. Right, so we said our dividends can be treated in much the same way as my drawings, since it is a negative equity. So as dividends increases, my equity is going to decrease, and that is going to be a debit. All right. Then, as my bank account decreases, you should by now know that that is going to be a credit. It's the opposite of dead click because it's not an increase, it's a decrease. So it's going to be a credit. Good. So let's go to our journal. Which journal do we record this in? We're going to record this in our subsidiary journal. We've paid money. We're not given a document number, so we can just fill in a generic one there. We've paid this on the 30th of June. So this is this cash payments journal for June. And this is Shape Up Limited. Our details here is going to be the people that we paid, which in this case is the shareholders. So we're just going to fill in here shareholders. Take out the financial institution. All right, how much did we pay them? We calculated that at 720,000. So we can put that in there. And then let's have a look here. We don't have any column for ordinary dividends paid, so we're going to put that in the sundry column, 720,000. And we're going to post it to our dividends on ordinary shares, which we have established is a negative equity account. Right, so now that we've done that, let's look at our general ledger. Good, so we're giving out money, we're paying dividends, which is a distribution of profits. Okay. Remember, dividends can only be distributed if the solvency and liquidity requirements will not be negatively affected. So what that means basically is that the company must still be able to cover their debts, their short-term debts and their long-term debts. So we're going to pay this from our bank account. So our bank account is a credit, and the account debited we said is going to be my dividends. And the amount should be this one that we calculated here, 720,000. So we can say calculation 1, 720,000. A bank is an asset. The dividends we said is like a negative equity. So that's why I color that similar to my expenses. Good, so this transaction was on 30th of June, so we can just complete that. Remember, my details must always refer to the other account, dividends and bank. This one is the asset, and that one refers to the negative equity, and this was recorded in my cash payments journal. So now I can do the posting on the subsidiary journal. My bank is account B2, my dividends is account N20. So let's do that. Dividends is N20 and bank is going to be B2. Let's put that in here. B2. Perfect. So now we've posted my asset and we've posted my dividends, which is a negative equity. Great. So the last thing for us to do is to show the effect of this first transaction, which is the interim dividends of 90 cents per share. Don't be confused by the fact that it was paid to 300 shareholders. That is just information given to confuse you. Okay, there's 800,000 shares that were issued, and that is what we use in our calculation. We use 800,000 shares, not the actual number of shareholders, because remember, each shareholder may actually own more than one share. So let's look at the effect on the balance sheet here. Well, we go back to my screen. We gave out money, so my bank decreased. So where is that shown on the balance sheet? That's going to be under cash and cash equivalents. So we go here. Cash and cash equivalents is going to decrease by the amount of the dividends, 720. And where was the other side of this entry? That was on my dividends on ordinary shares, which is like a negative equity. The reason for that being that my retained income that I will now be able to keep in the company after this distribution of dividends will be less. Right, so the company will make, for example, a profit of 1 million rand. All right, and it will decide, let's distribute 800,000 rand as dividends. Okay, maybe the company will make slightly more profit, 10 million rand, and they decide to distribute 800,000 rand as a dividend to shareholder. What that means is my profit that is going to be retained is then going to be the 10 million minus the 0.8 million. Okay, so my retained income decreases. If my retained income decreases, that is a negative effect on my equity. Good. Calculation 1. And that is the first transaction. So I'll make another video for you just to explain the second transaction, where we're going to look at the final dividends declared. At this point, I just quickly want to introduce the appropriation account for companies. So here is the T account. The appropriation account doesn't really fall into any specific category. It is a final account that we use to close off some of the other accounts. And the specific accounts that we're going to close off is my total profit and loss, which will be shown on the credit side. All right. And then on the debit side will be how we are going to distribute this profit. Remember that we have to pay tax since we are a company, so we're going to pay tax to the taxman, which is SARS. So we call that income tax. So a portion of the profits are going to be distributed to income tax. Then, if there is sufficient funds available, the directors may declare a dividend, and that is going to be my dividends. All right, and finally the amount that is left is what is going to be retained income. So basically I'm going to have my profit and loss figure, and then from that I'm going to subtract whatever income tax I paid, whatever dividends I paid, and the amount that is left will be what is taken to my retained income account. So if I have my retained income account here, this amount here will be taken to my retained income account. Okay, but we'll get back to this.